Welcome to this Elliott Wave Street volume profile plus Elliott Wave blocks part 1. As always, it's a pleasure to share with you this new knowledge that I have been working on, and we are going to cover this topic today with a lot of examples, and I'm sure you're going to love it. And this technique is going to work for any market, for any time frame. If you are swing trading, if you are scalping, if you are day trading, whatever is going to work, and on any market. So the plan tonight is working with volume profile at the beginning. Then we are going to combine the volume profile with Elliott Wave. And then I will present the Elliott Wave blocks. That is a technique based on the order blocks technique. So that's the plan. Tomorrow, the second class, we are going to work with more examples and more ways of applying the technique. And these are going to be the 2 free classes, the 2 free sessions. Of course, you are going to get a recording. I'm going to post this video in our YouTube channel as well, so you are going to have it there, these 2 classes. And then we are going to continue just for members on Elliott Wave Street with additional lessons about this topic. All right, so let's start. The plan tonight is explaining the volume profile in an easy way, in a practical way. So the volume profile is coming from the Gauss bell. The Gauss bell is a tool to organize data. So you can think on any set of data that you need to organize. So we're going to make some examples today with, could be the housing market and different type of examples, but something easy, right? Something easy is that this bell is going to show us where most of the data is at, and that's the average. So if I am selling ice creams, and I can tell that the strawberry flavor is the one that I'm selling more, that's going to be the average, right? If I have a class of students and I have the grades of those 100 students in my class, I can say if the grade is from, let's say, 1 to 10, that the average is 7. And I also can tell that with one standard deviation, that is the 68% of the data, those grades are going to be between, let's say, a 4, and on the other side, well, no, maybe not 4, let's go with 6, and on the other side with 8 will be the standard deviation. So that means that the average is 7, but 70% roughly of the students have grades between 6 and 8. And 2 standard deviations will be this area right here, and don't worry, we're going to make some other examples, but 2 standard deviations of the data is the 95% of the data. And we can say that those students, the grades from 95% of the students is going to be between 5 and 9, right? So that's it. It's just to organize a set of data with the average, with the 68% of the data, and that's it. That's the only thing we need to understand here, but let's make another example. Let's suppose that I want to buy a new home, a new house. So I want to buy this new house, and I'm going to start checking prices of other houses and some historical prices on the neighborhood. And after collecting the data of, let's say, 10 years or the last 5 years, I came with all this data, and I can tell that the price of the houses of a house in this neighborhood, the average is 350K, let's say. So that's the average. And I come here to the house that I want to buy in that neighborhood, and I check the price of that house, and I see that 2 years ago, that price was at 250. And let's say this was 2 years ago. Okay, so I say, wow, that was cheap because it was cheaper than the fair price, than the average price of the neighborhood. So 2 years ago, that house that I want to buy today was cheaper. I asked the price today, and the price is 500K. So clearly, it's expensive related to what? To the fair price. So the fair price here is the reference point of price for my new home. It's the reference point, so 350K. If I buy my house above these 350K, I'm buying expensive. If I'm buying below, I'm buying cheap. And let's say that I'm saying, no, I'm going to wait. And 2 months later, I ask the price again, and it's at 800K. And I say, what? But 2 months before was at 500K, and the average price of the area is at 350K. Yes, it's because the demand is increasing, whatever. Right? So of course, if I want it because I really want it, I can buy it, but of course it's not a good business, it's not a good deal. Let's say that I wait 1 year, and 1 year I ask again, and they say, oh, the housing market collapsed, and now the price of that house is at 150K. I say, what, really? But you were asking a year ago 800. Now it's at 150, and the average of the area is at 350K. Wow, that's fantastic. I want to buy it. Actually, I'm going to buy a couple of more of houses here on the area because it seems that they are cheap. So traders, in terms of market valuation, the fair price, the fair value, if we want to buy anything, if we want to buy the Apple stock, if we want to buy the euro, the S&P, anything, we need to buy somewhere here in this area. And if we are at a really good discount, we have a better chance of making money. If we buy when it's expensive, so remember on the right side, buying is expensive, it's unfair for buyers at this area, on the right of the average price. So if I buy here, it's going to be hard because the average price was here. If I buy below the average price on the left, I have better chances of making a profit. Now, what if we start talking about the stock or any market, the S&P, the oil, whatever? Let's say the S&P. If the S&P is at 350 and tomorrow is at 250, is a discount because this is the average price. So I can buy if I have a signal, let's say. But if the S&P is at 800 and I know that the average price is at 350, I can't buy. I should be trying to sell. So as traders, we need to buy cheap. That means on the left of the fair price. And we need to sell at expensive levels at the right of the fair price. You can see how important it is to find the fair price. And that's what we are going to work today. I'm going to teach you how to find the fair price of the market. That fair price in the volume profile, we are going to call it point of control. Point of control. The 70%, the one standard deviation of the data, we are going to call it the value area. Right? The one standard deviation that is 70% is 68%, but we can work with 70%. 70% is 68%, but we can work with 70%. Most charting platforms are going to, by default, show you the 70% in that volume profile tool. So we know that if we want to short any market, we need to short as far as possible from the fair price or the point of control. If we want to go long, we need to buy as far as possible from the fair price, right? Because we are traders. We buy cheap and we sell expensive. So the point of control is something absolutely important to think about and to learn in the technical analysis. So the thing here is that when we are working with Elliott wave, we have a lot of subjectivity, right? Elliott wave is subjective. Elliott wave can have different outputs, and of course, it can be frustrating for some traders. But look, when we add tools to Elliott wave, we can start moving a theory that is extremely subjective to something more objective, and that's the plan. So how we can incorporate the volume profile technique, the Gauss bell, into a chart like this one that is the complete Elliott wave market cycle. So look, if I bring the chart, it's going to look like that. So this will be the average price. This will be my point of control. This will be the 70% of the data. And if this is, let me change color here for the point of control so we can see it better. Make it a little bit bigger here. There we go. So if we want to go long, let's say, we need to try to find the trade far from the point of control. So if we already have the point of control, we need to buy here, we need to buy here, we need to buy here, as far as we can from the point of control. Once the price moves back to the point of control, we have to be careful because it's too late for buying and it's too early for selling. So when the price moves far from the point of control, it's good for sellers. So we can short or we can book profits from something that we triggered before. So remember, the point of control is where we have the most data in any series of data, the average, and is the fair price, and we call it point of control in the volume profile. When we want to go long, we need to buy below the point of control. When we want to go short, when we want to sell, we need to do it above the point of control. That's it. Never the other way, because that's something basic when we are trading. When we are trading, we have to buy cheap and we have to sell expensive. That's it. So let's have a look how the volume profile looks in a real chart. And we can apply volume profile on any market, on any time frame. It's actually pretty easy to apply it. And in this class, you're going to learn how to apply it. Also, inside the Members Academy in Elliott Wave Street in the education area, I have a complete course on volume profile if you want to learn a little bit more about this technique. But we are starting here with this chart, and look, the 70%, the one standard deviation on this profile is going to be this area. That's the 70% of the entire data. The point of control will be this red line that you have that I have here on this chart. But let's be more specific. What it actually makes the volume profile a point of control and why it acts like that, because there is something key to highlight. For example, in the Forex market, in the crypto market, we don't have volume. We don't have access to volume. It's only in the exchanges. The CME, for example, from the CME, we can get volume. But even from that type of source, probably is not the real volume. There are dark pools. The institutions, they do a lot of things that don't go through the exchange. And yes, we can have volume on the futures market, but we have to be careful. Maybe it's not going to be that precise. So the volume profile is a good solution because the volume profile is not being made by the volume of the market. It's not by the number of shares or the number of contracts. It's just by the time that the price spends in a level. For example, in this chart, you can see that right here, from this low to this high, that I'm doing the study from that cycle, you can see that the price traded the most time in this area. So the logic behind the volume profile is that actually measures the point of control actually will be the level where the price spent more time in the cycle. So we are saying here that from here to here, we have the price trading most of the time at this area, and that's why, and that's how the volume profile shows that the market has the strongest volume, let's call it like that, because it was taking more time there, the price to develop or whatever. So it's where the data was more time. That's the point of control, and that's the fair price. And makes sense because we have a balanced market. So that's the strongest volume accordingly to the volume profile. Of course, when you add volume to a chart, that again in the Forex market is impossible. Of course, if you add the indicator, it's going to show you some bars here of volume, right? But it's going to be just the broker volume, and that's it, or the tick volume, that of course is completely different to the real volume. And you're going to have some bars here on below each candle, right? And that type of volume is not related with volume profile. Volume profile just shows how much time the price was at an area. That's it. So of course, it's extremely useful because we can use it on any market. We don't care the volume coming from the exchange or from the broker or whatever, because it's not using that type of volume. It's just showing where the price was trading at the most in terms of time. So of course, that is extremely important. All right, so now let's have a look at the important parts of the volume profile. First of all, the value area, that is the 70%, is one standard deviation. Most trading platforms are going to calculate this area for you. If not in the settings, you can select colors, you can customize it. I'm using here TradingView. It's important that the platform that you are using for this tool comes with tick data. So you can use it on NinjaTrader, on TradingView, on TradeStation, and Thinkorswim, Motif Wave, but I believe MT5, but MT4, for MT4 is not going to work. Right? For MT4 is not going to work, so you have to be careful. And that's the 70%. Again, the point of control is the level where the price spent more time, and the whole area that we're studying, of course, is from where we start, like a Fibonacci tool. We start the tool from here to here. So of course, I'm going to show you how to pick those levels. So what is volume profile? So volume profile displays the volume of trades at specific levels by measuring the amount of time that price trades in the area. We can identify areas of high liquidity. Of course, that's when the volume is stronger. And also it's going to help us to find key support and resistance levels. So the value area high, the value area low of the 70% are important levels, and of course, the point of control. It helps to understand the market behavior and sentiment by analyzing the distribution of the volume, and shows where most of the trading activity takes place. And this is extremely important to understand from volume profile. Indicating the value area or price range where the market spends most of its time. Can be used in conjunction with other technical analysis tools like moving average, trend lines, whatever you like, Elliott wave, whatever. But it's also important to understand what is not volume profile. Volume profile is not a tool for predicting or forecasting the future price movements or having trades, and you are going to see why, but it's extremely useful to find them at the end with other tools. It does not display the total volume of the trades. That is not the right tool. If you want to check the real volume, this is not a tool to use, of course. It does not provide buy or sell signals on its own, but we are going to create here a trading system where we can use it to trade with this technique. And of course, it's not a measure of the market depth or the number of pending buy and sell orders at different price levels, like the book is not related with the book at all. And it does not directly measure the strength or weakness of a trend or momentum, right? For that, we can use other tools. So it's important to understand it. So let's start working with a case. This is the S&P, blank chart. So what I'm going to do here, I'm going to add a volume profile tool starting from here to here, right? So I'm going to add the study to the whole leg down on the S&P, to the whole leg down. Without adding the tool, I want to show you something interesting. We can start guessing where the point of control is going to be. Remember, the point of control is the place where most price was traded in terms of time. So, for example, this area is important. Right? This is a key area. A lot of price was trading there. This area here seems to be extremely important. Look, all the price that we have on this area. We have a lot of price on this area. So the point of control is likely to be somewhere here before we add the tool to understand how the tool works. And probably here as well. Right? So let's have a look. Where is the point of control? Okay. So, of course, with the tool, we can know precisely where the price was most traded in terms of time. That's the point of control. So, in general terms, of course, we are going to check this on lower time frames. We're going to make exercises on a 1 minute chart. So don't worry, it's just an educational example. So this is a daily chart, and we know that buying below the point of control is a good idea, and selling above the point of control is a good idea. Not the other way, right? So if the price is already above the point of control, I'm not going to buy. If the price is already below the point of control and far from the point of control like here, I'm not going to sell, right? So this is extremely important because this is basic market valuation. Look, this is the 70% of the profile. So this is a discount because the price is far from the point of control. Of course, we can start working with price action entries. This rejection, for example, that we work with that type of narrative on the membership. This rejection here, right? So of course we need to combine the area with another tool to trigger the trade. But we know that it's a good idea to trade far from the point of control. I'm not going to short here at the worst price possible. The same with the home example. I'm not going to buy my home at the most expensive price from years. I'm going to wait for a discount. I know the average price. I know the fair price. That is this one here. This is the fair price. So if I'm a good trader, I'm going to buy far from the good price, far from the fair price to the downside, right? So that's important. But also traders, this is a big cycle, but I also can start analyzing leg by leg. So for example, I can measure this leg, I can measure this leg, I can measure this leg, I can measure this leg individually. I can make the study of each leg. So let's do it. Look, so now on the previous chart, we were doing the study from the high to the low, the entire cycle. Now I'm doing individually each of the swings to the downside, each of the swings to the downside, each of the swings, right? So look, we can do a lot of things with this information. Here is the value area. Let's start with this first one. Here is the point of control. If I want to go long, I'm going to wait for the price to move far from the point of control. And when I have rejection or I have rejection or I have rejection, I can buy because the point of control is the fair price and it's going to act like a magnet. When the price starts moving far away from the point of control again, now I'm going to try to sell, right? Now let's draw the next one. Will be this leg down. Right here is the fair price. So if I'm going to short, I have to do it above that area. And if I'm going to buy, I have to do it below with a good signal. So right here is the 70%. And I know that at this area, the price is going to have something soon. It's going to have a retrace or it's going to have a change of trend. Of course, Elliott wave is going to help us with that. We are going to get here in a second to the live market. And look, here we have another one. the point of control is right here, the fair price. So you can start seeing the different cases. Look at this one. This one is a special, right? The fair price is here. And let's say that we are here. We can see a huge distance between the price and the fair price. So we know that the market is extremely cheap. And we need to focus on finding a signal to go long. That's it. We can't sell. Let's say that we are trading on the daily chart. We can't sell if we are here because we are far from the point of control. The point of control is up here. So we need to start looking for a buy trade. We can go to lower time frames. We can find a divergence. We can look for a rejection here. We can look for a wave 1 and 2 and start trying to go long, whatever, back to the point of control. The point of control is going to act as a magnet for the price because it's a fair price. Let's have a look at this next profile. So I'm taking the profile from here to here. Here is the point of control. The price comes down here and rejects. Let's extend here the point of control to the right. Rejects, moves back to the point of control and look here, we have price sideways, playing around with the point of control. So when we are trading, we need to find setups far from the point of control. If we want to go long, we have to buy far from the point of control. If we want to sell, we want to sell far from the point of control, right? So let's make the profiles now for the corrective legs. And that's how we can get to the real-time market. Look, so now with the corrective waves. So I'm taking the tool from this low to this high. Of course, we can measure cycle by cycle. It's actually simple, right? And here is the point of control of that cycle. So when I'm live right there and I'm above the 70% from here, I'm above the 70%. I know that all I can think is ways of trying to sell this thing because it's far from the point of control. So I wait for a good rejection. I can add distribution areas. I can add other tools to my narrative. But I can't go long because I know that sooner than later, the price is moving back to the point of control. So this is a selling area. The price moves back to the point of control, drops. Here creates another corrective leg. Here is the point of control. Price moves far from the point of control and returns. Look at this one here. The point of control on this one is higher than the others. So here the discount is not that good. Let's say, right? This one is a little bit more difficult to trade. Let's have a look at the actual one. So the actual, I'm taking this low and I'm including the actual price because I just take this chart before the class, so it's fresh. So we can see that this is the value area on the daily chart on the S&P. And when the price tries to get far from the point of control, is getting rejected, right? It's getting rejected and moves back to the point of control, as we are seeing in this example. So if I'm trading on the daily chart, the only thing I can do here is selling, right? I can't buy according to the auction process, to the volume profile tool logic. I can't go long at that area. So that's where I can start using Elliott wave. So I can say, okay, this is 1, this is 2, this is 3. This seems to be 4 active. I'm looking for 5. And at the rejection, I know that I can sell. And I know that we are likely to go back to the point of control. From there, the price can move a little bit lower or sideways, whatever, reject, and probably then we can have a wave 3, let's say, right? Or the price can move lower, whatever. But at this extreme, the only thing I can think about is selling if I'm trading on the daily chart. But let's move to a lower time frame because this is just an example. Of course, we're not going to trigger trades on the daily chart. When I move to lower time frames, and let's say that I'm in front of this pattern, this is like a P shape, right? The letter P. P as a Peter, right? So if you're in front of this scenario where the fair price is where the market is actually trading, you know that if you want to short, you have to wait for the price to extend a little bit far from the point of control. You're not going to sell here, right? So the next chart, look, the price moves far from the point of control, moves above the 70%, the value area high, and from there we have a rejection. So we know with a high probability that the market is going to move back to its point of control at this area. And on the next slide, right here, we have the price moving to the point of control. Right? And this is just the live market today. So we have the price coming down here. Today, in my daily analysis, I was expecting that the price was going to build another high here to complete the pattern, and then they move down to the point of control, right? Like to complete an Elliott wave that we were talking in the membership. I was looking for a hard high, and from there, the bigger leg down. Well, sometimes it can start the process before, right? As happened today. So it comes back to the fair price. So let's now check here the Elliott wave cycle, and look, we can add the tool for wave 1. So wave 1 is going to have a profile. Wave 2 can have its profile as well. So remember, if you have wave 1 and you want to sell, you need to sell above point of control. If you want to buy, you buy below point of control. If you are in the wave 2, so you are going to buy below point of control and you are going to sell above point of control. Of course, if you believe it's a second wave, you are going to buy at the rejection, whatever. And the same is true for all the waves. So we can individually add the tool for each leg. For 1, for 2, for 3, for 4, for 5, for the corrective wave as well. Look that the B wave is going to be where the area where the value area is going to develop. Right? And the C leg, if this is A, this is B, and this is C, the C is going to be far away from the point of control. And that's where we are going to buy. Always thinking in this auction process. We buy cheap, we sell expensive. We buy cheap, we sell expensive. Always. At the same time, the entire market cycle is going to have a volume profile itself. So we can have either or both, if we like to make the study like that, the whole volume profile for the complete cycle or individually for each cycle. So here is the actual S&P plan, Elliott wave plan. So as you can see, the price today did a big sell-off. As I mentioned before, this morning, I was looking for at least one more leg up before the bigger corrective. So sometimes that happens. But look, we have this sell-off, and without adding the tool, just with the class that we are having today, without the tool, now you can know where is the fair price. If we are checking this area, think about where is the fair price. Remember, the fair price is where the price has been spending more time. So from this area, clearly is this area. When the market is sideways, of course, when you have several candles moving, overlapping, moving sideways, that's going to be your point of control. So even without adding the tool, just by having this training, you know that that's the point of control. And we are going to add the tool in a second, of course. So you know that this area, that the price here is building the point of control. Let's suppose that you are bearish. Let's suppose that you are bearish and you believe that the S&P is going to crash, right? Like in social media and some reports, some analysts are saying the S&P is going to crash. We are going to the 3,000 area. Right? Let's say that you are thinking of that type of a scenario. Now with the auction process that we have in the chart, how you will trade it? Well, you will need to have the price moving apart from the point of control, and you're going to find a sell trade right here, probably at this rejection where the B finish by after the ABC 6 second, the candle close, we have a candle close below A, let's say, a rejection here. It's going to be your sell trade because you are above the point of control. And again, I'm going to add the tool in a second. But we know that that's the point of control, of course, because it's where the price is spending more time. And if you have that bias that the S&P is going to move down and you believe that that's the scenario because you are having that wave count, or because you like to use a technical analysis tool that is telling that, or because you like fundamentals, whatever reason. But your entry for a short will be there using this technique. Right? Let's suppose that you are bullish. I'm bullish. Let's suppose that you are bullish. So of course you are not going to sell here unless you are scalping or day trading. Of course, if you are you want just a short-term trade, you can sell it there and book profits here. But the buy trade, if this is the point of control again, this area here, let me change the color so we can be on the same page. That's the point of control, and the price travels far now below the point of control. We can wait for the price to reject this area below the point of control, and we can go long right there because we buy below the point of control. So the seller, the trader that believes that the S&P is going to move lower, whatever, will be finding the sell trade here, and the buyer will be finding the buy trade here. If each trader waits for the signal and is managing properly the risk, the one that is wrong is not going to lose money, right? Or if he loses money, it's going to be a small loss, and that's trading, right? But look how important it is to understand the market valuation. Now let's bring the tool, and here we have the wave count, and here we have the profile, right? So you can see that, as we were mentioning, that area right here is where we have the point of control. Easy, because the price is sideways, right? So you can do that exercise on your chart. Look, here you have a value area because the price was sideways. Here you have a value area, right? Without using even the tool, now you understand that here you have a value area as well. When the price is overlapping, when the price is choppy, when the price is sideways, whatever name you want to call them, is a value area. When you have candles just moving directionally, the market is in an imbalance, which means that there is no value, that there is no volume, that there is no fair price. But when the price transitions from trending to sideways is when the point of control is going to start building up. So that's simple, right? That's simple, just to keep it simple. So you can see that, of course, at the beginning, you need to use that type of tool to understand the technique, to play around with the tool. But once you understand how it works, then you don't need to use it. It's like reading price momentum. You can use a MACD, you can use an awesome oscillator, an RSI, a stochastic when you are learning. But once you master the technique, just with price action, you can see when the price is losing momentum, right? So that type of thing is my point. That, of course, is extremely, extremely important to understand, right? So you can see that that's the area. So we will need to have the price getting apart from that area, and then when it rejects below the point of control, we can buy it. Or if we are looking for a sell trade because we believe, and could be, right? Why not? That this is a wave 1 and this is a wave 2, and here comes a huge wave 3, right? Can happen. Of course, remember that anything can happen in these markets. But if that's our bias, the way to apply this tool will be by looking for the rejection right here as far as possible from the point of control, because that's the fair price. If you didn't sell above the point of control, and let's say that tomorrow the price is here, and you say, oh, I don't want to miss the trade, I'm going to sell here, you are too late. You are too late. You have to sell somewhere above the point of control. Because if you sell here, it's an area where buyers is fair for buyers, and they are going to try to do something clearly. Right? So it doesn't have any sense to try to do something there if it's too late. Right? Okay. So in TradingView, you can pick the tool. So manually, you pick from where to where. So you can select the cycle that you want to measure. Right? So that's the TradingView tool. Now, traders. And again, we have inside the Elliott Wave Street Members Academy a complete volume profile course. This is the way to apply it. But in case that you want to learn a little bit more, inside the Elliott Wave Street membership, you're going to get more details about the volume profile. Now let's talk about the order blocks. So an order block, traders, is an area, is the value area, is the point of control most of the times, because the institutional traders, they don't trade as we trade. They don't trade with small orders. We trade, let's say we are trading futures, we can trade with 5, 10 mini E-mini contracts, 30, 40 micro contracts, right, with a relatively small account. And the big guy, the institution, they trade with huge orders. And it's not something new, right? Of course, from the beginning, the institutions from the 1800s, 1900s, they were trading huge. So the problem that they face is that, let's say that they want to short, or they want to go long, let's say they want to buy Apple stock or the S&P or the euro or the Bitcoin or anything, any instrument. For all the instruments, it works the same. And let's say something crazy. They need to place 100K E-mini contracts today during the New York session. Imagine if that institutional trader that needs to place that order makes one click and fills the order, the whole order in one position. Well, if the S&P price is here, it's going to jump a lot of points and it's going to create a gap, and the execution of this order is going to be terrible for the institution, right? So of course they can't place the whole order at once. So they need to create order blocks, and that's splitting what they want to go long, short, whatever, in smaller size orders during the session. So let's say that the price is moving down and they start buying, so they start buying. When the price continues lower, they buy a little bit more. When the price continues moving lower, they buy more. When the price continues lower, they buy more, right? So they are doing accumulation, and they are slowly adding their position to the market, because they don't want to create a crash or a huge gap to the upside, to the downside, whatever. So they have to do it slowly. So they create orders, of course, at the lows, right? So they say, I'm going to buy here 1,000. I'm going to buy here another 1,000. I'm going to buy another 1,000. Those areas are also creating liquidity, because there, some traders are going long and are leaving their stops under the low, right? So of course, if the price moves under the low, they are going to take them out. So more money for the big guy. So it's fantastic for them. And there are different theories about why they need to go back to those order blocks. So there are some theories that they like to push the price back to the order block because they can continue filling their order at that price. So they have their algorithms have to continue buying at that area. Could be because they were trying to manipulate the market, and you can imagine all the theories that are around these order blocks. So look, when we have the price, let's say that the price was moving down and eventually turns up, right here, and I'm going to show you in a second how to draw the order block, right here was the order block, just at the end of the cycle. Of course, you're going to draw the order block after the fact. So when you have your order block, the next step in the process is that you wait for the price to move back to that area. If gets rejected, could be on the 5-minute chart or the hourly chart, when the price hits the area and moves back above the order block, so moving below, moving at the other side. Don't worry, we're going to see examples today. That's your entry point. That's your entry. And your stop is going to be below the order block. Sometimes, as in this example, price can cross the order block to take out liquidity and reject. The entry is going to be the same. It's not going to change anything if the price moves under the low. And the only thing that could damage the order block is if the price breaks the order block and doesn't reject. Right? That's another scenario. So the price breaks down and continues. So we are going to see examples. Don't worry about it. And here's the definition. If you already read it, if not, then you can watch the recording and read the definition. But it's what I just explained. So how we can incorporate that theory into the Elliott wave cycle? Because the Elliott wave cycle is fantastic. The Elliott wave theory is something that I believe every trader should at least learn the basics, but it's extremely subjective. Imagine this scenario. We have a new student, and we are going to ask the student to read the Prechter Elliott wave book. And we are going to give that new student a month to read the book. And then 1 month later, that student, let's say, that was reading the book several times, 10 times, and he is an expert in the Elliott wave theory because he knows all the guidelines and rules. Maybe he doesn't have experience, but he knows all the rules and guidelines of the Elliott wave theory. And we are in a nice place in Manhattan, in New York City, near Wall Street, in a nice conference room, and we are all together, and we ask the new student to come into the room, and we say, okay, new student, make your magic. Okay, so what I learned is that when you have a wave 1, after the wave 1 is coming the wave 2, so you are going to buy, and the invalidation for the wave 2 is the previous low, so you are going to buy because it's the second wave. So you have wave 1, and you have wave 2, and you're going to buy because you have a wave 2, and you are going to capture the wave 3, right? He is going to explain the theory from the book. And we say, okay, that's interesting. Makes sense. Okay, so how you can tell that this is a wave 2? Oh, that's easy. Because on the left, you are going to have a 5-wave sequence for wave 1. And then you are going to have a retrace that actually at the end, it doesn't matter how much you retrace because you have the 5 and you can go long anywhere. Oh, okay, really? And why are you saying that? Because the Elliott wave theory says that the second wave can retrace from 1% to 99%. Oh, yes, you can use some Fibonacci levels. You can use some Fibonacci levels here to as a reference to find where the second wave is going to finish. But the book says that it can finish on any of these levels. Okay, so you are saying that you are buying because it's the wave 2 because you have a 5-wave sequence on the left. Yes, that's right. And in the real life, traders, when that happens, when the trader goes to the real life and starts trading like that, he's going to lose the entire account. Right? He's going to lose his entire account because actually that's not the proper way to use the Elliott wave theory. And I understand that any person in this world that reads the book or learns the Elliott wave theory is going to think like that. And that's completely wrong, right? So first of all, traders, I believe that a key thing to understand in technical analysis is that technical analysis is not a crystal ball. Technical analysis is not something to read the future. I believe that it doesn't exist. So some people think that studying technical analysis is having like a time travel machine that they can go to the future and see what's happening in the future and come back and make money. And that's completely wrong. That's completely wrong, traders. Technical analysis is not going to work in that way of thinking. It's crazy, right? It's crazy. So it's if we think like that, if we think that technical analysis is a forecasting tool, Elliott wave, a moving average system, candlestick patterns, whatever, their job is to read the future. That's crazy because there is no way of reading the future. We don't know what is going to happen tomorrow in our lives. Good things, bad things, whatever. It's impossible. Nobody knows the future. So why Fibonacci tools or Elliott wave theory or whatever are going to read the future for us? So technical analysis doesn't work? Yes, it works, but not for reading the future or for forecasting the future. That's a huge mistake, and it doesn't have any sense, traders. So using technical, I can tell that 99% of traders are using technical analysis like that to forecast the future. And that's a huge mistake. It's the same as going to I don't know, someone to read our hand or to read the cards or the crystal ball. It's exactly the same. It's crazy, right? It's crazy. Of course, if I hire someone to read my hand, that person maybe could say things that at the end happen because he was lucky. That's it, right? So we have to be careful with that. So technical analysis, traders, measures or give us the tools to understand what is happening right now, what is happening today. That's it. And of course, we can check what happened before. That's it. And by knowing what is happening today, for example, with the profile exercises that we were doing, we have an edge because we can know if the price is cheap or expensive. We can see what the big guy is trying to do. We can see what they are trying to develop. So let's go back here to this example. If we are here at the wave 1 and we look for a corrective wave, a second wave, the thing is that if the price is moving down slowly, it's because someone is buying, and that someone is the big guy. So while the price is moving down, he's using order blocks to go long and pushes the price higher, right? And the price moves down slowly, and the price rejects. So when we read the present, that's when what we can see that is happening. And we are not forecasting the future. We are trading the present. We are reading supply and demand. So that's why I believe that is something crazy to use Fibonacci levels. That's absolutely crazy. Doesn't have any sense to use Fibonacci levels. The 38.2%, the 50%, the 61.8%, the 78.6%. That's crazy, traders. That's a distraction. But something that is real is that if we look to the left, in each turning point, we are going to have order blocks from the big guy. So that's where the price is going to react. And that's fantastic when we combine it with the profile and with Elliott wave, because now we can have an objective approach to know where the price can turn without using a crystal ball or crazy Fibonacci levels that clearly don't work. So that's why, traders, I call this technique the Elliott wave blocks, because I'm using the order blocks with Elliott wave. So let's make examples. This is a bar chart. For this part of the training, I'm using a bar chart because I want to explain how to draw the order block, and it's extremely easy. First step, find a turning point. So this is a turning point. You can find a turning point when already happened, when you are here, when you are here, when you are here, when you are here, right? So it's not something that you're going to find in real time because you don't know that that's a turning point. You see that it's a turning point after, right? Same here. Once you see that you have a turning point, a low, whatever, you are going to find the last candle that was making a low on that trend. So you have low, low, low. Find the last one. Find the candle that did the lower low from that sequence. Okay, so clearly it's this candle. Okay, so we have our first part of the order block. Second part, look for the second candle after that candle. Okay, will be this one. Great. Find the low, this one here. Find the high of the two candles. Okay, this will be the same candle because the other is an inside candle. Project that box to the left. Woo! That's an order block. We found that the big guy was doing something there. That's the big guy order block. How to use it? Each time that the price comes inside or hits or rejects, we go long. For example, first one will be this one here. The price moves inside the Elliott wave block. Let's say that this is our wave 1 and the wave 2. The price moves inside, rejects. Great. Here we have another rejection. Then we wait, and here we have another rejection. So those are entries, bullish entries. Now let's draw the Elliott wave blocks from the other side. From here, you can draw all the ones that you like. So last candle that was able to make a high, this one, and the next candle. Draw a box of the range, of the whole range, from high to low of those two candles. If the second candle is lower, draw a lower. If it's inside, well, you have to use the first candle. Great. So look, the price tries to break the order block, the Elliott wave block. It was successful. Nope, it rejected. In this case, the short entry was here. That's too far, of course. But that's a signal. Probably if you were long from here, you can book profits. And you say, okay, this is my wave 1, let's say, or my wave A, or any wave that you're looking. And this is my second wave. Now you have an objective area where you are looking, where you are waiting your second wave to have the price come in there. If the price doesn't come there, you don't trade. But you are not adding crazy Fibonacci levels. You can add a profile. You will say, okay, look, here is where the market was sideways in this area. So that's my fair value. Right here is my fair value. And below value, I can go long at the rejection. Right? So that's the entry point. That's it, right? Let's have other example. This is a 1 minute chart. Of course, you can do it on the daily chart. And of course, you are going to have a lot of fun finding these levels. Oops. This is a 4 hour chart. And again, it could be the S&P, it could be the Bitcoin, it could be an Apple stock, it could be anything, any time frame. And you are going to see that from now on, this is so simple. And from now on, you are always going to understand why the market reacted at that level. Look at this one. This is an interesting example. The last candle, let's find this swing. The last candle high the last candle high. Well, this red one here, and the next candle, look at the next candle. So when you have a huge candle, as the second candle, only use the first one. Because if you use both candles as the order block, it's going to be a huge area, right? Later on another session, we are going to talk about the multiple order block or Elliott wave block analysis. So in this particular case, when you have that the second candle, the second bar is huge, just use the first one, right? That's it. Because you know that the big guy is not selling here, of course, right? So those are little tricks. Look, the price comes here, rejects, this candle is going to be your entry. The stop could be either at the high of that candle or the high of the order block area. In this case, it's a 4-hour chart. We need to use just the high of the candle. If it takes us out, we have to trigger again, right, on the next one. The plan is to find the rejection. Booking profits, taking profits. So we look at the next Elliott wave block that will be here. And right there, we can book profits from the sell trade. If our bias is to the upside for some reason, we can buy here or we can buy here. Right? Of course, if we start using the profile, those are not going to be good buy trades. But anyway, could be, right? We can think, okay, those are buy trades. Yes, of course. Right? The price in this particular case comes under the Elliott wave block, but then rejects. Let's have a look at another example. The S&P. You're going to start seeing all these Elliott wave blocks everywhere. So look at this example here. We have these as our Elliott wave block. Price moves far, returns, rejects. Moves far, returns, rejects. That's easy, right? It's extremely easy. It's extremely objective. Of course, then we can add the wave count and we can add the bias. Look at this example, now linking together, putting together the volume profile and the block. So this is a profile. There is the point of control. Let's add the price. Okay, good. And we know that the point of control of a previous cycle is going to be important for the next cycle. Okay, now let's draw the Elliott wave block of this area here. That's in the next slide. Ta-da! So I'm drawing this one by taking the last candle high with the next candle low. If we believe that this one is too big, the next candle, right, that's, of course, you are going to start picking your favorites. And let's say that you draw it here. Well, in that case, you didn't execute your trade. It's a 1-minute chart. It's a scalp. So if you were waiting for something to reject there, you will miss this one. If you use, in this case, 2 candles, I don't think that is a huge distance in this case, right? Look, beautiful. The price comes there and rejects. If we were looking for the straight, so we look to the left. Let's draw the Elliott wave block on the left. So the high candle, the high candle of the previous cycle, high with the low of the second candle. Oops. Let me try to draw it more precisely there. There we go. Oh, rejection. So that's a signal as well. Right? Oh no, my bias was bullish. Okay, so you draw it here on the previous low candle. And here will be your buy trade. Probably you get enough to have a 1-to-1 or a safe trade with this distance. If not, you have a loss in that particular case, right? Okay, let's draw the next one. Let's have a look at this area as well, right? So of course you have to be careful drawing, and we're going to check that in the other lessons, because sometimes when we start doing with this technique, we start drawing tiny blocks, right? And it's important to keep it like bigger, especially on these lower time frames, right? But you can start drawing all of them. Look at this example here. 1-minute chart, S&P. So, and this technique is fantastic for scalping. So you draw let's say that you're starting your trading session, whatever, and you have time to draw the Elliott wave block. When the price comes to the area and rejects, it's a buy trade. And I'm going to add the profile in a second. That area, the turning point, is going to be a new Elliott wave block. Then the next trade, when the price, and if the price returns to the area, could be here. That didn't work. If we have a tiny stop, if we have a bigger stop under the Elliott wave block, that first trade would be active. Then was another entry that actually was better. Look, the price moves inside the Elliott wave block, and then we have the candle closing at the other side. Fantastic, right? And from there, the price moves up. Of course, there are going to be home runs. Of course, there are going to be trades that don't work, right? Of course. Now let's add the profile into the narrative. So for the first trade, the one here, we are far from the fair price, from the point of control, and we are on a 1-minute chart. So I'm measuring the profile from the high to the low. And this is the fair price. I'm buying below the fair price. Second example, the fair price is closer to the price. Not as good as the first one, but we are buying below the fair price. It's still a good deal. That's it. That's it, right? If you have this Elliott wave block here, and the price crosses the Elliott wave block and doesn't reject, you're not going to sell it. That means that they were not in a bearish narrative when the price just crosses up the area. If you are long from before, you are not doing anything. You are not going to book profits. You're going to wait. If you are looking for a short, let's say that you start your session and you're saying, oh, this is my wave 1. I'm looking for a second wave, and I'm going to capture a wave 3 down. Let's say that that's your bias, because sometimes it's going to happen like that. But the price comes to the Elliott wave block where you are looking for a sell trade. You are not going to act, right? Let's see an example that you will be acting if you were looking for the sell trade. So right here is the Elliott wave block. So let's suppose that you have here the wave 1 and you think that this is the wave 2. Of course, you're not going to sell this one because look at the slope of that price. You don't have any divergence. You don't have anything. Of course, but let's suppose that you are just using the technique as a robot. So you sell here. Right? Of course, we can start adding the process of the ABCs and all the things that we cover in the membership to filter out some trades. This is too fast. But anyway, let's say we sell it there. We leave a protective stop loss here or here. We're scalping. So those distances are tiny, are 2-3 points. Okay, take us out. Okay, I sell it again here at the next rejection. And on this one, I was able to have a good trade until it rejects here or here. I have to be careful. Because in case that I was looking here for a wave 3, should cross down easily and didn't cross down here. So if I look at another example, look at this one here, NVIDIA. And again, we can apply this technique on any market, on any time frame. Right? Of course, this is just the first class from, I think we're going to have around six sessions about this topic, because there are some other details that are important as well. This is just the introduction. And but everything is going to be related with this technique, right? Of course, we're going to start mixing this up with Elliott wave, and of course, in the membership, we are going to continue doing exercises every day during the week in all the markets that we cover in the live markets, right? But anyway, look at this example. So we have this Elliott wave block right here. So we can say that this swing was the one that was building the Elliott wave block. So this is entry number 1, right? Works nicely if the stop is here. This is a 1-minute chart. It's a great technique for scalping. The price moves here to the Elliott wave block, moves up, so it's closing shorts, maybe going long, if that's the bias, moves back to the Elliott wave block, bounces, so you know that it's time to close any buy trade. If you like the short, you sell it. Moves down here, rejects. Moves up here, rejects. This time, doesn't move back to the Elliott wave block, returns, moves back here, and we have 3 rejections. Moves down nicely and has a signal here to close the trade or to go long. If we go long, this is the first one that didn't work from the whole narrative. The price breaks down the Elliott wave block, never validates up again, never closes above again, continues, moves to this previous Elliott wave block, crosses down and rejects. And that's the live market. So it's bullish. It's bullish. Okay, so we are now seeing things too little. Let's go back for a second. Let's understand the profile here without the tool. Where is the profile here? Where is the fair value? Here, somewhere here in this area. Right? If you were trading here inside, you will be selling above point of control. This will be the point of control, this black line, right? Point of control. So you will be selling above, buying below, right? But here, this one is fantastic because you are far from the point of control. So, and this is a live chart. We will check later, tomorrow, whatever, what happened here, because this was the live market. This is the live market, right? So the plan here is going back to the point of control, and there's a signal on the 1-minute chart, right? Which other big level is important here? Of course, this area. So that's the high will be somewhere here, right? So the first task you need to start doing, and no matter the instrument that you're doing this, could be anything, right, is to draw the bracket. The market is going to trade in that bracket. If you are scalping, you act here on the 1-minute chart, 15-second chart, 10-second chart, whatever time frame that you like to scalp. If you are day trading, go to a 5-minute chart, 15-minute chart. If you are swing trading, use the hourly, the 4-hour chart. And the daily chart, maybe just for analysis, because it's too big. We are not trading on those time frames, just to understand what's going on, right? So we start understanding that when the price is overlapping, is the fair value. Remember, when the price is overlapping, when you draw a line in a chart and you see that many candles are there touching the line, hitting the line, that's a fair value. Even if you don't have the tool, oh, I don't have a platform that comes with the tool. It doesn't matter. That's the fair value. That's it. Right? This is unfair. Unfair for who? Unfair for buyers. Fair for sellers. Is far from point of control. Right? Under the point of control is fair for buyers, unfair for sellers. Same here. So you are here are only thinking you're not going to sell here. You're not going to sell below the point of control. You're only going to buy. That's it. It's the auction process using the profile tool or the profile understanding of the auction process and the Elliott wave blocks, that is a completely objective way of trading the markets. Not all the trades are going to work. I have bad news for you. This is not a 100% technique, but it's a technique that you are buying at cheaper prices, that you are having a small stop loss, that you have potential for easily getting to the 1-to-1 risk-reward ratio. It's not a forecasting tool. It's not telling if the price is going to move 100, 200 points to the upside. It doesn't exist, the type of tool to forecast the market. Right? Doesn't exist. The day that someone finds out exactly what the market is always going to do next, the day that someone finds the way to travel in time and travel to, imagine that thing, I will travel, if I have the time machine, that will be the first thing I will do, I will travel for 2 weeks from today, and I will take pictures or whatever I can, or notes, whatever, of the S&P. I will come back to my present, and I will sell my car, my house, everything, and I will trade heavily during those 2 weeks, and I will probably take out all the liquidity of the market. And the Fed, in order to sustain the market, will need to print money to give me the money, because I will take all the money from the world in the financial markets. So of course it doesn't exist. Remember, traders, our job is not to forecast the future. Our job is to make money. Our job as traders is to understand the present. And when we understand the present, we can make money. That's it. Sometimes it's going to work fantastic, the trade, and it's going to be a home run, and we can do 10% of the account. And sometimes we can just barely have a break even. That's it. That's the reality of the market. Yeah. All right, traders. So that's it for today. Tomorrow we're going to continue with more examples. If you have any questions, you can contact me here. I'm going to publish the video in the YouTube channel, so later tonight, you're going to see it there once it gets ready. Take some time processing. Also, we're going to send you an email with the link. And if you are subscribed to the Elliott Wave Street membership, you are going to have this video in the Members Academy, the second video tomorrow. That we have these 2 free classes this week. And then you are going to have the whole course, because we're going to continue meeting just for members after that. So let me show you. If you haven't activated your Elliott Wave Street access yet, you can visit us on elliottwavestreet.com, then click on the membership and pick your plan. That's it. This week, on the daily market analysis videos, we are going to cover a lot of Elliott Wave blocks in the real markets. So pick your plan, start your trial, and you will get immediate access to these lessons, and also to the live market analysis with real-time analysis, with education, and a lot of fantastic things we have inside the Elliott Wave Street membership. So thank you very much for being here, traders. Please have a fantastic rest of your day or your night, and I'll see you tomorrow. Take care.